Good morning. It's Friday, May the 15th. It's Friday, everybody. Here's what's on our agenda. Warm words in Beijing, but Trump spooked the oil markets. We watch gilt as Manchester's mayor plots a path back to Westminster. And global yields rise on higher for longer inflation fears.
And I've only got 3. I could have 6. I could have 7. There are so many assets on the move this morning. I think it works kind of like this. President Trump says he doesn't care about the Straits of Hormuz. Brent rises. You then get a pickup into the US 10-year yield. We go through 4.5. Yields globally are rising. We'll talk about that in a moment. Equities then sell off in response to that. Take a look at Nasdaq futures. Take a look at what is happening here in Europe. Euro Stoxx 50 futures are down by 1.4. I think that's how the choreography works. But there's a lot of moving parts this morning. And certainly the risk rally that we've seen in places like Korea certainly feels like it could be under threat this morning. Anyway, really interesting trading to go into the weekend. The countdown to the opening trade starts right now.
We did discuss Iran. We feel very similar to Iran. We want that to end. We don't want them to have a nuclear weapon. We want the straits open. We're closing it now. They closed it, and we closed it on top of them. But we want the straits open, and we want them to get it ended.
So, President Trump, within the intimacy of Zhongnanhai, which is the leadership compound, I should say, in Beijing. It's not often that US presidents get inside Zhongnanhai. It's a hold-them-tight moment for Xi Jinping, with a stern message on Taiwan, a stern message on needing to have a framework for stability. And at least for now, Guy and Anna, no obvious signs of giveaways from China. Yes, we have a number on Boeing orders, but that's disappointed some. Yeah. No detail in terms of agricultural and commodity commitments. They may come through. We're still waiting for those headlines. That could well come through. We could see commitments on soybean purchases, on oil and gas purchases. But so far, we don't have that detail. But there is a clear framework now, at least from the Chinese side, and that's 3 years and beyond. We'll see if Xi Jinping commits to returning with a visit to the US in September. That would be significant in terms of building on the work that had been put in place. But I think the key takeaway from now is this relationship has stabilised. They've put in a framework, at least for now.
That's what the Chinese want, isn't it? The Chinese don't want the volatility of the Trump era. They're trying to contain the Trump administration and make sure that we don't see the kind of tariff volatility that we've seen in the past. Is that something that the Trump administration is going to be happy with? This has been a much tougher summit than I thought it was going to be. Everybody thought this was going to be kind of, we were going to see big deliverables coming out of this. The line about kind of Western decline, I think, is interesting. What has happened with Taiwan, I think, has been interesting. The Chinese are giving a tough line, but the overall framework they're trying to create is one that contains Trump. And these lines that we've just heard really speak to that.
Yes, it's really interesting, isn't it? As we watch these live pictures, President Trump's Air Force One, of course, getting ready to leave China as this summit comes to a close. I wonder if the full relevance of it is quite clear yet, because on face value, some of the lines look very warm and fuzzy and friendly, and you know, a lot of bonhomie between these two leaders. But on the other hand, as you say, Guy, there's a lot that is about containing. I mean, one on trade, she says that China and the US have agreed to stabilise trade relations, and if instability is one of your key policy tools and one of the levers that you like to pull, then yes, does this clip your wings?
Take a step back, and these are two powers now on equal footing, and that is the key difference, and that is the difference between previous presidential summits. China feels it, China knows it, and it can back it up. Two powers on an equal footing, and that's how they've communicated around these 2 days.
It's in the line. Both sides should implement consensus reached.
But we don't know the details of what that is yet, do we? I mean, it's possible there's still news lines to come out from this as the US team.
And it's really interesting. I think one of the papers this morning was talking about this. You've now got a September the 24th return visit, away game for the Chinese.
If Xi Jinping accepts that invite.
If Xi Jinping accepts that. And what the Chinese will then do is, within that period, basically use that as an anchor point and say, you can't change anything between now and then. Basically, this is stasis now. Don't do anything on Taiwan arms. Don't do anything to upset the trade story. Basically, between now and then, the relationship is kind of frozen as is in terms of the consensus.
Is that market positive?
Possibly, yeah. in some ways. Maybe you take the volatility out.
In the same way that this meeting was certainly something we were referencing as constraining people and their actions, particularly in the Middle East, ahead of it. So from 3D chess, perhaps, in China to 3D chess in the Labour Party and plotting ousting of the leader there. Let us talk about what's going on in UK politics, because the pound is weakened once again. It lost nearly 1% yesterday. It's down 0.4% against the US dollar. Now, we're waiting for the gilt market to open in 55 minutes' time. Andy Burnham, then dubbed by the press the King of the North because he's seen as somebody who might have a chance of holding off reform. He has a plan to get his seat back in Parliament. So we go to another level in the bond market conversation and thinking about what he means fiscally, and we've had a few clues over recent months and years.
So I think it's really the first thing I think to say is it's really hard to take out what is happening in the gilt market from what is happening globally in bonds. So I think we'll talk about bonds in just a moment. So I think you need to see it in the context of a bigger bond move that is taking place. If Burnham's the only guy that can beat Farage, he's got to beat Farage in South Wigan, which is where this is, basically. So if he doesn't, then the Labour Party's a lame duck. And I think this is really dangerous territory for the Labour Party, therefore. If he does win and does beat the Reform candidate, and you talked about this yesterday, he's talking about tearing up the manifesto effectively. Can he do that without going back to the country? And therefore, you've got another test potentially coming. When do you get a general election? When will Burnham call a general election? October, possibly, definitely not kind of December. Or do we wait until next May? So that then heightens the risk around what he then needs to do.
So that's a potential sequencing as we get one piece of the puzzle put in place and the complexity of the moves ahead to get to that point. But that's a potential sequencing that the markets should be focusing on. I'm wondering if it's too myopic to think of Burnham as someone who is going to roil the markets with expansionary policy and not caring about the bond markets. This is someone who has, he's worked with Corbyn and he's worked with Brown, but he's also worked with Tony Blair as well. He is someone who adjusts.
He worked for the Treasury.
And he worked for the Treasury. He is someone who reshapes himself to the current political climate.
Chameleon.
There's a chameleon. There's a chance that he reshapes himself to the fiscal realities of the UK
and Bloomberg
as well.
Economics has done a deep dive on some of the things he's said already, but of course he'll have a lot to say from here. But you put this in the context of what we're seeing in global bond markets, and that was certainly important yesterday because despite all of the domestic politics, we saw yields substantially lower in yesterday's session on gilts.
So I think you do need to think about what the UK is going through, but I think you can also view it as emblematic of some of the problems that we're seeing elsewhere around the world. In terms of what we're now getting, so you've got Japanese yields rocketing higher. Are we about to see a rate hike there? That feels increasingly likely. The US 10-year clearing 4.5. That feels like a major moment as well. Are we on track to 5%? 5% feels like a kind of press emergency button for markets globally. Equity markets have responded. And you've seen certainly Nasdaq futures rolling over. You've got futures here rolling over. You've got the Cosby under pressure as well. So how close are we to the kind of moment where equity markets get really nervous about what is happening here? Yeah,
there's so many interesting dynamics here, and it is hard to know where all of this starts. But the oil story does seem to have added an extra dimension to it today with President Trump, as you said, Guy, saying he doesn't care about the Straits of Hormuz being closed, although there were other things he also said. But it's at 107 right now. Another angle on this, another dimension, is the competition that govies are now facing from corporates. And we've got big tech trying to raise all this money, not just in the States, but globally. And you know, that's something that's being talked about in the Japanese markets. Alphabet had that big raise.
Alphabet raising more than $3 billion. The biggest non-Japanese raise in the Japanese markets. They've raised about 60 billion Alphabet over the last 4 months. There's a redhead across the terminal. Coming back to Guy's point on what's been happening in terms of the sell-off in JGBs. So Japan's 30-year yield rising to 4%. That's the first time since 1999. And so the question is this the moment where the stock markets, as you look at the Kospi down 6.5% today, 6.5% drop for the Kospi, is this US futures, Nasdaq futures pointing low, European futures pointing low, is this the moment where the equity markets wake up to the concerns about inflation and higher yields?
You've got this gamma line as well, which is pushed on, and it needs to keep moving up if you aren't going to get a big reversal in terms of what the dealers are doing. So you wonder what market internal dynamics are also going to come into play here and how that's going to factor in. First time since 1999 on that 30-year, i.e. ever. That was when it debuted. So ever. Paul Skinner's going to be joining us very shortly from Wellington. We'll talk to him about all of this. Laurie Calvasina's on this side of the pond, RBC Capital Markets US Equity Strategy Head. Looking forward to hearing what she has to say. And Charles Myers, Signum Global Advisors Chair, joining us later on in the programme. Tom.
Here's what else we are watching throughout the day then. Iranian and Russian officials attending the BRICS foreign ministers meeting in New Delhi. Jerome Powell's term as Fed chair ends officially today. Historic market then, and US industrial production at 12 or 2:15 p.m. UK time, and the deadline for 13 FS filings as well, and we'll be unpacking the details of those for you.
What else do you need to know this morning? Cuba's government says the country has completely run out of diesel and fuel oil. It needs to keep these things to keep power plants running. Civil unrest is starting to break out amid de facto US energy blockade of the communist-run nation, with social media posts showing sporadic protests breaking out. The US has cut off the island from virtually all fuel imports since January, only letting a single Russian tanker through in late March. This is obviously a derivative of what happened in Venezuela. LVMH is selling Marc Jacobs, the brand, to WHP Global. Jacobs, the label's founder, will continue as creative director for the affordable luxury label. Those two things go hand in hand. The acquisition will push WHP Global's annual revenue to more than $9.5 billion. And Cerebras shares jumped 68% in their Nasdaq trading debut after raising $5.5 billion in the year's largest IPO. The surge gives the AI chip maker a market value of at least $67 billion. That puts its CEO and his stake at $3.2 billion. This according to the Bloomberg Billionaires Index.
Coming up on the programme, Gilt set to face pressure this morning after Manchester Mayor Andy Burnham opens a path to challenge Prime Minister Keir Starmer. We will have more on that shortly. Plus, OpenAI's Chief Revenue Officer has been speaking to Tom, says the company is seeing incredible momentum with its enterprise offerings. We will bring you more of that exclusive interview with Denise Dresser later in this programme. Up next, we'll be joined by Paul Skinner, Investment Director at Wellington Management. Lots to discuss: inflation, what to expect from the gilt market at the start of trade. Plenty on the agenda. ID plus BBTV Go is the function on the Bloomberg terminal if you want to get in touch with us and the opening trade team. This is Bloomberg.
Friday morning, 44 minutes to go until the equity market starts trading. Could be an ugly one. That's the picture you see on the screen in front of you. Those are the European futures. Take a look at what's happening in Asia. A significant sell-off is taking place there. Nasdaq futures are down reasonably hard. Now, I say reasonably hard. Take a step back and look at what we've delivered over the last few weeks. So you just need to see that in the context of those gains. But we are maybe struggling a little bit this Friday morning to see the glass as being half full. Let's quickly talk about what is happening in the bond markets. This is the picture there. Again, this is really where the narrative lies. And as you can see, you've got pressure to the upside. You can see it in Japan. You can see it in the United States. And you can certainly see it here in Europe. The long end in particular is pushing higher. How worried should we be? The bond market is sniffing out inflation, sensing inflation. Paul Skinner, Wellington Management Investment Director, joining us to discuss. Good morning.
Morning, Guy. Good to see you.
Worried about the bond market?
Very. Yeah, I mean, there's no question.
Okay.
Yeah, no, there's no question that we are now entering a period of significant volatility. You know, we have a lot of pressure coming from the Straits of Hormuz on inflation, but we've also got a background where central banks have been a little bit easy on inflation for the past few years. So, combination of a supply shock and embedded inflation is going to cause us.
So what do you do?
I think the only solution is raising rates. Now, I think the ECB are showing their colours. And, you know, they're quite clearly going to be raising rates. It's nailed on for June. That's the right way to go about it. You have to get this under control. And I think, you know, if we look to Japan, we can see how not to do it. You know, well, you know, they've got short-term rates at 0.75%, and their 30-year is at 4%. That's a huge, steep yield curve. That costs a lot of money to fund, and it's because that Bank of Japan is very politicised. They had a cabinet minister sitting in on the last meeting, and as a result, they have not raised rates sufficiently quickly for the inflation issue they've got. Inflation's 2.5%. That's a negative real yield. That's immense. So, you know, if Japan is the role model. We're going to be looking at weak currencies for central banks like the Bank of England, who are on that extreme of being growth protectors rather than inflation fighters. The inflation fighters, the ECB, the Swiss National Bank, they're going to have an easier ride of this.
Yeah.
But the worry is if we let those yield curves go.
Is there so letting the yield curves go, yes. And Jean-Claude Trichet was here recently, and he used to talk about having one needle in the compass. You know, it's just about inflation. That's the only thing that should matter. But it gets more complicated. The conversations talk about growth, and, you know, at this kind of level of oil prices, you get demand destruction, and people are talking about weakness in the growth story out of Europe. How do you avoid those hikes being a policy mistake, or do you just have to face up to the fact that it'll be called that by somebody, and that's just how it is?
Yeah. You have to face up to the fact. You have to take that step to reassure the markets. You know, that's essential, that if inflation surprises on an even higher side, you've at least done something. We've got, you know, a model from the 70s. In 74, we didn't raise rates sufficiently. That ended up in stagflation and a real crisis. 79, we'd learnt from the central bank. We raised rates, and it was all over and done much, much quicker. So the truth is, central banks have to, you know, bite the bullet, raise those rates, and things will normalise. The problem with you know, some of these countries, like the UK, is the fiscal story behind it. And, you know, we've got that whole political ramification that's happening in the UK that essentially says that the Labour Party is moving towards less fiscal responsibility. If we listen to that speech on Monday, Starmer, regardless of the leadership concept, has stated that, you know, the two things they're going to do is they're going to meet reform by moving to the heart of Europe. That'll differentiate them from reform. But they're also going to have no fiscal austerity on public services. Now, that means that budget that we had last year is simply not going to hold, because that encompassed some of the biggest departmental cuts since the World War II in 28 and 29. They're not going to happen now.
OK, a lot we don't know about the UK fiscal position. Let's just get some input from what's happening in China.
Right.
We have President Trump just arriving at the airport, ready to take off back to the United States via Alaska, I assume.
Yep.
But we've seen pictures of Air Force One, the team waiting for him. I assume he's there. I assume
he is. That's
the beast.
That's the beast.
They shipped the beast to Beijing.
Yeah.
He's in it. He's about to get out. You can see his security detail around the car, and then he'll walk up the steps. This is his second visit as a president in a presidential role.
Yes.
To Beijing, Capital Airport, and then fly to Alaska.
As we continue to watch those pictures, I mean, Paul, if we see central banks around the world putting up rates to take on inflation, that doesn't reopen the Strait of Hormuz. That is in the gift of the man we're seeing now getting onto Air Force One and the Iranians.
I think some of the disappointment is that that they didn't get any sort of deal regarding Iran from the Chinese.
They talked Iran, we understand, but
talked about it, and they talked about Taiwan. There was a hope that they could get some deal together. Now that's not happened, and I think what we've got to realise is the Iranian population are stronger than people think, and we're looking for somebody to back down. And at the moment, it's not going to be the Iranians. You've got to remember they have far more diversity in their economy than just oil.
OK, as we watch President Trump getting ready to leave, let's get an update on where we've got to on the conversations in China, the relationship between the US and China. Min Lo is in Beijing with us and can take us through some of the key takeaways from the trip. Then, how do things look then on day two?
Yeah, it's been a whirlwind 36 hours, right? And I think Tom was right in saying that one of the key, win for China is the optics of this, the warm relationship, and how US and China appears to be on equal footing here as President Xi hosted Trump to a visit to the Temple of Heaven, and this morning to Zhongnanhai, the gated compound where President Xi himself lives and work. And not many global leaders have had the privilege to enter that area for the candid talk that they had over morning tea today, and admiring those roses and trees that are over 100-year-old. But in terms of substance, that's a little bit wanting, right? In terms of actual deals, we have the two Bs, Boeing, a 200-jet deal that was less than expected. Many people were expecting as much as 500 jets, so we saw the stock of Boeing fall on the back of that. But still quite a significant one, just given that it puts an end to a near decade-long freeze in orders from China China. The last time we saw such a big deal was when President Trump last visited back in 2017. The other B, you have Boeing and you have beef. Yesterday, China renewing licenses for hundreds of beef plants in the US after allowing those licenses to lapse last year again. This is a big deal because last year we saw a collapse in those imports. But again, the environment here is such that we have these beef producers in China already grappling with overcapacity. So the actual volume of trade remains to be seen. The third B, soybeans, no forward movement on that because Jamieson Greer said that was already agreed upon in Busan last year. So no change on that front, and China is on track to meet those commitment of 25 million metric ton of soybean imports per year. He did say, though, that there will be a double-digit billion dollars worth of agricultural imports. What sort of agricultural goods? Not clear at this point, but we are seeing corn futures rising as a result. What didn't come through is tech. We have seen, all that news about Jensen Huang making that last-minute addition to that American delegation, and a lot of anticipation about whether we would see a rollback of tech curbs or at least China agreeing to buy those H200 chips. Greer said that is going to be up to Beijing. Reuters said that apparently NVIDIA has gotten clearance to sell to up to 10 companies, but we haven't gotten the official confirmation from the Chinese side yet.
OK, Bloomberg's China correspondent Min Min Lo, thank you very much indeed on that update. As we see, of course, and have been watching President Trump returning to Air Force One. He'll be travelling back via Alaska, of course, to the US after that two-day state visit to China, of course. And Min Min talking about some of the announcements, Boeing and beef, but still waiting for details in terms of tech. That's really important, of course. And there's been a lot of speculation. And in fact, some stock moves on NVIDIA on the back of speculation that maybe the H200 would get that approval from the Chinese officials. As yet, as Min Min was saying, we have not had clarity on that. Let's bring Paul Skinner back in now, Wellington Management Investment Director. Paul, as we look through and past this summit then, is there a risk for global equity markets of an air pocket ahead of NVIDIA earnings between now and NVIDIA in the short term? What are you watching for when it comes to equity markets?
I think there's no question that momentum has been so aggressive on the upside that the risk of a correction is there. And, with a background of bond markets looking a little unsettled, with the problem of inflation and the Straits of Hormuz not having a resolution out of that summit, I think there's definitely volatility to come. And, I think that when you get valuations as stretched and as concentrated in as few stocks, that correction can happen quite easily.
The focus here certainly is on what's happening with the politics and gilts. You've been talking about the BOE and your suggestion that maybe they're behind the curve in terms of addressing the inflation.
Absolutely.
Here in the UK. What would gilts looking? When do gilts look attractive to you?
I think there's going to be a really exciting moment when the Bank of England finally get their conversion and they start to raise rates. I think there will be an incredible opportunity to lock in some of those long rates because inflation's not going to be with us for the very long term. Yeah. And, there is a great opportunity.
Do you have a number in mind?
Oh, that's really putting me on the spot.
Give me a number.
If we saw the 30-year get up above 6%, 6.25%, somewhere like that.
7?
I don't think you're going to get to 7. I mean, it would be a proper crisis if we got to 7. I would be a buyer, at 6.25%, above that level, sort of. I'd be very excited.
Where would that leave the 10-year?
Sorry?
That leaves the 10-year at what?
Well, I mean, the
10-year... 5.5?
Yeah, 5.5. I think that's comfortable. And what we've seen is there's immense retail buying in bond markets at that 5 to 5.5 level. So, there's a inherent belief that people get good value above 5% in fixed income markets, and they can lock that in for their retirement and feel very happy.
Nice to see you. Paul Skinner, Wellington Management Investment Director. Coming up, we're going to have more on the political uncertainty in the United Kingdom. 3 senior Labour politicians consider challenging Keir Starmer for the top job. Lauren Van Bion, Senior Portfolio Manager at Allspring Global Investments, is going to be joining us. We'll talk fixed income a bit more. This is Bloomberg. Morning, how you doing? I'm just going to lean around Lizzie Burden. Half an hour to go until the start of trading here in Europe. I probably could have looked at the clock and figured that one out. Futures look a little bit like this right now. A lot of red across the screen around the world when it comes to equities. Bond markets are the real story, though, Anna. That is where the narrative is this morning.
Yeah,
what are we seeing?
Absolutely. A volte fast from yesterday on the European bond space, because yesterday we saw yields in decline, actually, across Europe. But then since then, we've seen Treasury yields higher, Japanese yields higher, and today in Europe, we see yields higher. So we don't have the UK awake and playing yet. We wait another half hour for gilt markets to open. That will be a very interesting dynamic, given what's been going on in UK politics. But for the moment, we've got France and Germany and Italy and Spain all up by 6 or more basis points at the 10-year horizon. So that's the focus for the bond markets. Now, let's dive into some of the UK politics. The pound tumbled after one of the UK's most popular Labour Party politicians moved to mount a potential challenge to Prime Minister Keir Starmer. Greater Manchester Mayor Andy Burnham says he's seeking to run for Parliament, raising the prospect that he will mount an effort to replace Keir Starmer. For more, let's bring in our UK correspondent Lizzie Burden, who's been following this story, of course. And this isn't a done deal, is it, Lizzie? Because he has to win a by-election, which is no small feat.
Yeah, far from a done deal. So he's got to, first of all, get the approval from the National Executive Committee. Starmer isn't going to stand in his way, we understand, as he did previously, and the seat went to the Greens. Then, as you say, he's got to win the seat. And this is something that Reform are going to throw the kitchen sink at. When this seat was contested in 2024, Labour won it by 45% of the vote. Reform won 32%, and it was the 6th highest vote share for them out of all of the seats. But if Burnham can beat Reform in a by-election, he can say he's the man to take on Farage at the general election. Yep. Still, though, it leaves the question of what happens to the mayoralty in Greater Manchester. And the pollster, Robert Hayward, saying Burnham could win the by-election, but Reform could win that, and it would take the likes of Gary Neville to keep it Labour in Greater Manchester. Then, sorry, but there are more steps. Then he needs the 81 MPs to support him to be in this leadership contest. And by the way, are Labour MPs going to have the patience to wait around for Burnham? But for all of those hurdles, he's the man who is leading in the Polymarket odds, and YouGov says he's the only senior UK politician to poll positively among voters.
What happens if he doesn't win, and what happens if he does win? So those are the. It feels really binary in terms of kind of two really distinct paths you could go down.
So I know your theory. Your theory, Guy Johnson, is that he'd want to call a general election.
Depends how far he gets away from the manifesto.
Yeah.
That's Starmer's manifesto.
But have you heard that joke? That there was a Blairite, a Brownite, a Milibandite and a Corbynite walked into a bar, and the bartender says, "What can I get you, Mr. Burnham?" I reckon, some reckon, he might be talking to the left as he tries to get the position of leader of the Labour Party, and perhaps he could pull to the centre once he's in that position. We saw it with Starmer.
No one's done that.
And that didn't go well, though. And that precisely that didn't end up, because he ended up getting nothing done because the left of the party was annoyed that he couldn't do social reform and all the other things.
But the problem that you're flagging is that there is potentially a gap between the rhetoric of Burnham right now and the manifesto as it stands. If he wants to keep this massive majority, which surely he would want to and need to, then he needs to steer closer to the manifesto, and this is the way to do it.
Or call a general election. Silence from
TBC.
Back to Guy Johnson's theory. Lizzie Burden, thank you very much indeed with the update on UK politics. Let's get some market analysis right now and bring in Lauren Van Biljon, Senior Portfolio Manager at Allspring Global Investments. Lauren, thank you for joining us around the desk this morning. We're set for a brutal sell-off, it seems, in gilts today. Are you braced for that?
Oh, I mean, yesterday was going so well, wasn't it? Not just for gilts, but for everywhere. Today looks like it's going to be a much nastier day. And yes, UK is trading as a higher beta developed market. So if what we're seeing in Asia is anything to go by, it's going to be a bit of a messy start for gilts as well.
Do we just brace ourselves for significant volatility in the days and weeks ahead for the gilt markets? How should investors be thinking about taking any opportunity, about positioning in gilts at the front end, at the long end, inflation versus politics?
Yeah, that really is the question. It's been a volatile couple of months, right? We know, given the macro backdrop, given the oil price shock, global bonds, the rates market has been really noisy. Double-digit moves in either direction, multiple times a week, and I think we're in for that sort of that is the state of play. I think for the gilt market in particular, very long duration gilts have been a difficult buy for quite a while. That remains the case. But I think it's more interesting if you look at kind of the belly or the intermediate part of the curve, where you've got that interplay of sort of inflation versus that delayed growth, downside risk, and more exposed to the sort of global wash, as it were, of pressure, which I think long-end gilts will trade very much just on the political upheaval.
Good morning to you, Lauren. The team at Bloomberg Economics has been combing through some of the things that Andy Burnham has said before about the economy and what he'd like to do. The thing everyone focuses on is not being in hock to the bond market. He said that was taken a bit out of context, and that actually he has he would have a wider suite of policies that would make the UK more investable. So, is it possible for them to make peace, Burnham and the gilt market? And I wonder this because he's talking about somebody has to fund defence spending. Somebody has to fund a lot of things in the UK, just like in lots of other Western countries. It's difficult to know where the money comes from. So is there a way that the gilt markets can accept flexibility on fiscal rules?
It's always about degree, isn't it, of flexibility? What are you giving up in return? And what are you being paid to take on that extra spending? And certainly, gilt curves the whole yield curve is higher and flatter than it was. So you are being paid more, but are you being paid enough? Perhaps not quite clear. I think my hope for any Labour politician or any politician in general is that there's pragmatism, right? And just face the reality of what the market is telling you and what you can and can't do and what's open to you.
Yeah, could there be a path that involves changing fiscal rules, so having some rules, but they're just different to the ones that we have?
They are self-imposed. Yeah. So, yes, there's no rule there.
They're not dictated by anybody other than politicians themselves.
Yeah, absolutely. Yeah. There's flexibility in theory. In practice, it could be a more delicate operation. But they're not fixed.
How high could UK 30-year go? UK 30-year, not the US 30-year. We were just hearing from Paul Skinner. He reckons you could get to 6.5. How much more upside is there in this yield move?
It's difficult to say because we're trying to piece together so many different bits and pieces. Yep. Is the Strait of Hormuz open or closed? Where's oil prices? Is there
an upper limit in where would you buy? Where would you be a willing buyer of UK?
Of a UK 30-year gilt? I think 6.5. Anything above 6.
Right.
Especially, I suppose, how is that looking versus its developed market peers?
Sure.
If it's 6.5 and everywhere else is where they are right now, absolutely, that looks pretty attractive.
Yeah, looks pretty attractive.
If everything is 100 basis points higher, maybe the UK needs to be even higher than that.
Are bond markets going to force central banks around the world, including the Fed, to raise rates? Does it feel like that's the direction of travel at the moment? Usually, kind of the bond market tells the Fed what to do. And I'm wondering whether we're getting in that kind of space again.
I think for us, also, this year is more about policy divergence. So I think the ECB, they will raise rates. Okay. Probably two rate hikes there, maybe second half of the year. Our base case for the Fed is still that they cut, but maybe it's not until the fourth quarter.
How are you feeling about that?
There are certainly some risks to that forecast.
What's the logic? What's the logic for the cut?
I think part of our base case is that the energy price shock will start to dissipate over the next 2 months. It's that there is some solution there for the US and Iran, and it's sort of in the nearer term horizon. And I think if we see that, and we've got a labour market that's sort of stable to weakening, I think the Fed will lean for the labour market and kind of look through that sort of inflation shock. I think what's really key to watch is going to be core versus headline inflation, because the core, if that sort of core is still fairly well behaved or at least stable, then I think the Fed will cut. Because
the bond markets are suggesting convergence, not divergence, around central banks. BOJ will be compelled to hike. The BOE is set to hike on market readings and in the positioning. The ECB has already signalled that, to your point. And the Fed, given the metrics that we're seeing and the data, despite Kevin Walsh, it seems difficult to see how the Fed can cut in this environment when the economy is broadly ticking along, when unemployment is looking pretty healthy, the jobs market is looking relatively healthy. And we're starting to see that impact now, PPI and CPI.
Yeah, PPI absolutely, because it's that input pricing, right? It's that supply side shock. Yeah. But if we're not seeing it carried through to the demand side, then I think the story changes. So something to watch, I think, for the next couple of months is going to be manufacturing versus services PMIs, and potentially telling that for Europe, services PMIs, most latest readings were not just below where they were outright below 50.
And what role does the Bank of England play then, either at the short end or along the, wherever on the curve? I mean, we heard from Pill at the Bank of England yesterday, and he's often quite hawkish, and he was sounding typically quite hawkish about inflation. But the Bank of England, it's often the inflation print is a little bit above the target.
Yes, exactly. And Q1 GDP, not a bad number. But interesting there, even to read the Bank of England's own theories that, that seasonality perhaps is changing, and it's that strong Q1 number, and then it's sort of doldrums for the rest of the year. I think the BOE would love to just not do anything this year, right? Just sit and watch and wait. And I'm not sure if the market's going to let them do it.
Get the popcorn. Watch number 10.
Exactly.
Watch what's happening.
Exactly. But when I look at pricing, if we're pricing in similar moves from the Bank of England to the ECB, that doesn't look quite right to me.
Lauren, thank you very much. Thanks so much for coming in this Friday. Lauren Van Billion, the Senior Portfolio Manager at Allspring Global Investments. Sticking with central banks, it's Jay Powell's last day as Fed Chair, and one governor is weighing in on Powell's plans to remain on the central bank's board.
Transitions are important, and I think that, it is maybe helpful to have someone there to give advice, but I still think it's important that it be a transition, because you want to have people's loyalties undivided. You want to have there be very clearly one chairman. You want to have a place where there's no question about who's in charge, and there's no talk of rival factions and things being split.
That was Stephen Myron, who will leave the Fed himself when incoming chair Kevin Warsh is sworn in. We'll have more on the challenges facing Warsh and the Fed. That's next. This is Bloomberg.
We are getting a real big supply side shock into inflation in an economy that's already got very strong demand at inflation. And I think that people are not fully registering how bad this could be later on this year.
This takes time to filter into core goods. So exactly as it says, it's more, I wouldn't say we have to wait as far as 2027, actually. I'd say later on this year, you could start to see core goods inflation picking up because of these disruptions.
It has been growing, it's been festering. I think the Strait of Hormuz exacerbates it. You're going to have kind of upstream inputs into plastics, the diesel to transport things around.
The feeling we have is that if the Strait of Hormuz continues to be shut by June, we have the risk that they feel they have to do an insurance hike simply to avoid second round effect of energy prices feeding into the economy more broadly.
Gilt market worries do look at the data, the fact that the UK's inflation rate has averaged 3% since 2010. That doesn't sound like a lot, a 100 basis point delta to the 2% inflation target, but compound that over 15 years, there's an enhanced inflation premium.
The US, we've also seen that, where the bond markets are a little bit more concerned than the equity markets about what's going on in the Middle East and the impact on inflation. But basically, if you're bullish on the markets, what you're bullish on is AI.
Just a few of our guests and other Bloomberg contributors talking to the show this week, talking to the opening trade, discussing pressure on global bond markets amid higher oil prices and political uncertainty. Let's turn now to today's Markets in 3 minutes on the opening trade with Paul Dobson, Bloomberg's executive editor for Asia Markets. And Paul, we heard a host of voices there talking about various themes, that some of them coming back to the bond markets, and certainly today's focus for global markets seems to be about what is happening in the bond markets. Yields are higher. We see that now in Europe. We're waiting to see what happens with the gilt market when it opens. We can't move for headlines around what's going on the JGB market this morning. What are you seeing in global bond markets? How concerning does this look?
Good morning, Anna. I think in isolation, or if you're looking at it in the round, not that concerning at all. If you look at an index of returns on global bonds so far this year, it's about flat. It hasn't really gone anywhere. Corporate bonds have been performing strongly, and shorter maturity bonds have been hanging in there okay. But it's the back end of the yield curve where all those problems are, and those are the bonds that are most susceptible to inflation, and those are rising all around the world, particularly today because we've got a another push up in oil prices, which of course spills over into the inflation outlook. Plus, we had figures from Japan. The PPI numbers were extremely high. We had the US CPI data earlier in the week. That was also on the heavy side. So people starting to get worried about how elevated inflation is going to be, what central banks are going to need to do to keep that under control. And that's been causing losses at the back end of the yield curve and pushing up those long-term borrowing costs for governments and for corporations.
Paul, are equities down because yields are up, or is it the fact that we've just had a great run?
I think that there's definitely a sense of both of those two things, Guy. You can certainly make an argument that a couple of the reasons why higher bond yields might be unfavourable to equities. One, people have been leaning into stocks for so long. Why would you want to own bonds? Maybe would be the flip side of that. But the higher yields mean higher borrowing costs, mean higher costs right across the economy. So that at some point does turn into more of a negative for the stock market. But I think that, we have had that good run. I think there's a little bit of disappointment in the air over the Trump-Xi meeting. I don't think that a great deal of positive takeaways for the market there. We've still got the war going on in the Middle East. Okay, you might think that hasn't been such a big element, but it is definitely, still pushing up costs in the economy through those oil prices. No sign of resolution into another weekend here.
A strong day for the dollar, Paul. What's driving dollar strength today?
Yeah, so I think that it's all part of the same story, more or less. People like the dollar as a haven and a risk-off asset. People like the dollar with higher oil prices because the US is a net producer. And people like higher treasury yields as another sign of sort of a tailwind for the dollar as well. So the market has moved more in favor of the idea that the Fed is going to be hiking interest rates at some point, and rather than cutting interest rates, because it's going to have to because of those inflationary risks in the economy. So that's pushed up the short-term yields and it's pushed up the money markets as well. Spills back over into the dollar on a relative yield basis. People find it a little bit more attractive. But I think that, on the flip side of that, look at the biggest decliners in the currency market. It's all of those commodity currencies like the Australian dollar, South African rand that had such a good run as well. So that's getting a little bit of a puncturing as people take some risk off the table into the weekend.
Paul, thank you. Have a great weekend. Paul Dobson, Bloomberg's executive editor for Asia Markets. Let's bring in Chloe Mellet now for a check on your stocks to watch this Friday. Chloe.
Good morning, Tom. LVMH is going to be in focus this morning. It is selling Marc Jacobs to WHP Global. And so for LVMH, this is part of a strategy of moving away from those more accessible luxury names and refocusing on higher end labels like Louis Vuitton, for example. And this really also is a way to capitalize on a years long turnaround of Marc Jacobs. That could also pave the way towards more disposals, more divestments for LVMH, which has been operating in quite a difficult consumer environment lately. We've seen the shares really have this fall from grace over the course of the last few months. But the news of this deal, that might actually provide a much needed boost for that stock. Moving on, but staying within luxury, and we've got Salvatore Ferragamo, which makes luxury footwear. And there they had sales that disappointed analysts with a lot of weakness actually in Europe and in Asia, but then a little bit of more of a resilient performance in North America. And so that could weigh on the shares after quite a mixed performance. And analysts are saying that a return to profitable growth this year looks quite precarious because of the work needed on wholesale exits, decline in China, and also a difficult start in Europe because of those lower tourist flows that have affected other names in that sector. And finally, we're also going to be looking at Stellantis, which is going to be making Jeeps in China with the Chinese company Dongfeng. So this is a deepening of a relationship that has been rekindled just very recently, and this could boost the shares for Stellantis. As we can see here, it's been having a very tough year, down almost 30%. We had this huge drop around February. The earnings have not been received very well, but the strengthening of those ties with China, that could potentially provide a boost for Stellantis this morning.
Chloe, thank you very much. Chloe Mellet with some stocks in focus. We'll throw into the mix Nokia. This because the Finnish market was closed yesterday, but a couple of days ago, middle of the week, we got those numbers out of Cisco.
Cisco.
Yes, it was Cisco. I can't remember 2 days ago, clearly. Cisco really flying. 19% it was, wasn't it, up after hours and then up really strongly in session. And so is there read across into others who operate in a similar related space? Pivoting towards AI seems to be something that is good for companies these days.
Are we watching ASML this morning?
We can watch ASML. Nvidia's performed very well as well. So the read across from ASML because of what's been happening again in some of the providers to the chip giants over in South Korea. And so you had a bit of upside there.
Was it AMAT last night?
Yes. So exactly. Applied Materials gaining at least after hours on the back of that number in terms of what they're supplying, particularly into Samsung and SK Hynix. The Korean market is falling pretty significantly today, but within the context of those gains, of course. So there could be some read across to SML, also, of course, supplying into those foundries. Nvidia is up about 20% in the last 7 days, closing in on a $6 trillion market cap.
Yeah. So I think Nvidia's added more than RTX is worth. RTX, huge kind of industrial giants, in terms of market cap over the last few days.
Yeah,
just kind of a sense of scale.
And in terms of when those gains happened, it wasn't all around the Trump-Xi meeting, but there did seem to be quite a lot of expectation about, especially as he hitched a ride from Alaska, there did seem to be a lot of expectation about maybe there was going to be a big announcement of an ability to sell into China. And despite some, low-level news lines around what was going on there, that we don't have that kind of big picture deal on chips or H200 wholesale being allowed by the Chinese into China. And so Nvidia doesn't count on any China sales of H200, does it? But it might have to stay that way.
Ford is partly a China story now. Have you seen the chart for Ford? I think we've got it over 2 days. 20%, almost 20% gain for Ford, a maker of cars, because this is supplying energy solutions to data centres. An analyst put out a note, but the IP comes from China. The IP comes from CATL or CATL, that electric vehicle battery maker, and Ford are licensing this IP and this tech.
Are we in the crazy phase now where anything kind of with
anything
this attached
that touches
to it
AI
is have we been there for a while?
Is that a signal?
The Ford maybe a bit of a signal. I don't know.
Yeah, well, the CEO was talking about de-risking the reliance on autos, which is exactly what you think about when you think of Ford. But no, now they're going to be into large energy cell production thanks to that China connection. And maybe it was appropriate that this news dropped this week, given the US and China relationship.
Ford was obviously one of the big stocks in the 1920s. Just takes you back there, just in terms of that narrative.
Thanks for that historical perspective. Guy, thank you. Coming up, it is the open, of course. Brace yourselves for potentially some brutal selling in the gilt markets. Energy is a story, inflation is a story, but the politics as well. European futures pointing low by 1.2%. This is Bloomberg.
Morning, how are you doing? A couple of minutes to go until the Friday session gets underway here in Europe. That's where Europe went out in the US session yesterday. That has nothing to do with what's about to happen in terms of the equity session that we are about to see. We basically went sideways. What is going to have an impact on the equity session that we're about to see is what is happening in global bond markets this morning, where yields are charging higher. Before I hand over to Tom as well, I just want to say Ford, not listed in the 1920s, did have something to do with the 1920s, though. Tom.
Oil above, Brent above 107 right now, to your point on the inflation risks and that bond sell-off that we're seeing globally. Just look at JGBs, just look at what's happening in terms of European sovereign debt, treasuries as well. Yields up, the dollar is getting a lift, bonds are down, oil around 107 on Brent, and WTI comfortably above, or less comfortably above, $100 a barrel right now. European futures then, there's some nervousness here, pointing up by 1% right now. FTSE 100 futures with the overlay of political risk in the UK as well, pointing low by 65 points, down 0.6%. DAX futures looking to lose potentially 267 points right now, pointing low by a little over 1%, Anna.
OK, let's talk about some individual companies and indeed sectors that could be in focus this morning. We'll keep an eye on everything tech-related. A bit of disappointment perhaps on what's going on over in China. No headlines around chips, and so Nasdaq futures are a little bit weaker. But maybe some in the tech space get a boost from Applied Materials, the semis equipment company coming in with numbers that were better than expected overnight. So that's something we'll watch, the sort of interplay between those two dynamics around tech. LVMH is also in focus, an asset sale there. They're going to be selling Marc Jacobs, that label, to WHP Global. Marc Jacobs stays on as creative director at that affordable luxury label, out of interest. And Syensqo, which is a specialty chemicals business, will watch that company because some of their numbers beat estimates. Guy.
OK, here we go. Time for the Friday session. Let's talk about some numbers. Let's show you what is going on. We're expecting a fairly weak opener this morning to be delivered by European equities. We are anticipating that we could be down by circa 9 0.1%, maybe a full percentage point on some of these markets this morning. The bond market is certainly unnerving the equity market this morning. You've seen that evidence out in Asia. That was the narrative there. You've seen Nasdaq futures in particular roll over stateside as well. So what are we going to get here in Europe? Europe didn't go up as much. Does it therefore go down as much? That is a question that maybe we need to ask ourselves this morning. The Danish market, I think, is closed today, so just be aware of that when you think about some of the big stocks that are going to be on the move as well. So the CAC's down by, let's call it 1%. The IBEX is down by a full 1%. The AEX in Amsterdam, let's see how tech trades there, down by 0.7%. The FTSE 100 is down by 0.6%. Overall, where does that take us? A stock 600 that is down by 0.8%, Tom. Sectors?
There's a bit of a tilt to the safety of telecoms. Currently, that is a sector that is up 0.4%. Just 3 sectors in positive territory, 2 now. Energy up 2%, of course, on the higher oil prices. So 0.4% gain coming through for telecoms. Energy up 0.2%. Every other sector in negative territory. Biggest losses coming through for basic resources. That was one of the biggest losers across your sectors yesterday as well. Silver is under pressure. Copper, gold as well. Basic resources currently down 2.7%. Banks also taking a hit, largely you would expect, on what's happening in the bond market. So banks as a sector down 1.6%. So basic resources, banks, real estate, all facing some pretty significant selling right now. And just really one major sector in positive territory. That's telecoms, healthcare getting a bit of lift, up 0.7% as well. Less than 0.1%, I should say. Telecoms up 0.2%. But that's the picture. Basic resources really taking it on the nose right now alongside banks and real estate.
Yeah, it seems the dollar impact weighing on commodities, and as a result, some of those commodities are weaker. Those prices are weaker, and so we see that sector underperform. Let's go to the gilt market because this is interesting. We now have the market, to what extent, this is an open question, to what extent are we pricing in Andy Burnham and the potential for him to become leader of the Labour Party? There are many hurdles to get through before we get to that point. But UK 10-year yields up by 11 basis points. That's a chunky number. It's double digit. But I will just throw in that this falls into a market that is already worried about inflation. Yeah. Italian BTP yields are up by 7. So do you take the difference between those two as some sort of premium for UK
Is that what we're now? So the UK and the Italian bond markets are now
not the comparison that many would like, but this is a sort of. Yeah.
Well, the spread is there.
Taking
in terms of the UK 10-year at 5.1 versus BTP's at 3.84.
So. Yeah, but I think Anna's point stands as much as the UK is up more than most this morning, but everything is up quite substantially, I think would be maybe the takeaway.
Yeah, absolutely. So still perhaps a long way to go. Timing's still unclear on the UK political narrative. We'll get more of that, more of an update on that as we go through the programme. This is a market, though, that is digesting. This is an equity market session that is digesting higher yields around the globe. Let's bring into the conversation Laurie Calvasino, RBC Capital Markets US Equity Strategy Head, who is here in London. Really nice to see you, Laurie. Thank you for being with us today. How resilient do you think the US equity story is to a higher yield environment? Give us your take.
So look, higher interest rates, whether it's Fed funds or 10-year yields, they tend to depress PE multiples. So that's something you have to take into account when you're thinking about a forecast. And I'll give you a sense of our latest numbers. Last week, we inched up our S&P 500 forecast, which is a 12-month number, not a December 31st number. We had been at 7,750. We took it up to 7,900. And the 7,900 was really derived from a valuation and earnings test, and we actually specifically bake into our PE calculation 4.5% on the 10-year yield. We've got a flat Fed, so we don't have any hikes or cuts coming, and then we've got 3.3% on inflation for CPI. And that's based on a stress test our economists did where they had it moving up much higher this year. This is all pegging off to 1Q27. And it's interesting. So the math we came up with was 79.29. That's based on earnings of 329, which is about a 5% haircut to consensus. And I apologize for all the math. I know it's early.
All right, just keeping up.
But what I would tell you is when I just take that PE assumption and I swap in 3.8 on inflation and I add a couple of hikes in and I take 10-year yields up to 5%, I lop off almost 2 points on the projected multiple. If I use the same earnings, I take the projected forecast for fair value from 7,900 down to around 7,400. Okay. Now, if I were to just take earnings down by 5% year over year instead of just taking the consensus down 5%, that would get you to 6,300. So that math really just goes to show you it is the earnings story in the U.S. that props the numbers up, that gives you a decent forecast. Interest rates, the pressure on PEs, that is a headwind to work through.
Okay, so it sounds as if you're saying, and correct me if I'm wrong, Laurie, that your stance on stocks, you're positive on US stocks, and it's resilient to some degree to a higher interest rate environment, certainly 4.5% 10-year, maybe even more. But it does rely on those earnings forecasts.
Exactly.
And what if those earnings are then threatened by a higher interest rate? Because we've got a lot of companies spending a lot of money, which is going to be costing them something.
Well, look, if you look at net debt over time, it has come down for the S&P 500. And what we also have seen in recent years is that companies have really pivoted more to long-term debt and away from variable and short-term debt. So I would argue that sort of the profitability of the S&P 500 is just less susceptible to moves in the 10-year yield than it has been in the past. The other thing that's important to understand about the resiliency of earnings, now when I mentioned that 329 number, that's a 1Q27 trailing 4Q consensus number. We basically went in and looked at the consensus, which has about 28% growth for AI-focused stocks, and we left that alone. And we went in and we looked at the market ex-AI, and we actually haircut those numbers, took the growth down from about 14% to 6%. So, and we're still coming up with a pretty decent number overall in terms of earnings growth for the S&P. So what I would tell you is there's just an inherent resilient bucket with that AI story that gets less caught up in some of these cyclical issues.
Okay. It's a lot to unpack.
It's a lot of math. I'm sorry.
Yeah, it's okay. I think I kept up.
There's more math in my meeting, so you're getting off easy.
Excellent. I'll stay here. How much of the Q1 earnings season, which was spectacular, was driven by what is a huge splurge by the hyperscalers and a deficit the government is running, which is off the scale for peacetime? We are running a massive deficit in the States, and I'm wondering what happens when that fiscal impulse starts to fade in the U.S. economy.
So, look, if you look at the industrial sector, it has been expensive forever. And I have been having conversations with U.S. equity investors, small, mid, and large, growth and value, all varieties. Everybody loves industrials in the U.S. Even my international clients love U.S. industrials. And I have been hearing about, the E is understated because the earnings power is massive because of all these things that Biden did. Infrastructure Act, the IRA, the horribly named IRA, the CHIPS Act, and now we've got the one big beautiful bill. So there has been one stimulus measure after another under both parties, and I have just had investors willing to overlook that in the industrial sector, despite my warnings that it's looking a bit overvalued. Now, what I would tell you, if you zoom back to sort of 1Q earnings, we have this one chart in our deck where, and this is simpler math, so this one will be a little bit easier.
Thank you.
But it's just a little grid, and we basically look since the beginning of April, before reporting season started, changes in 2026 earnings growth forecasts on the consensus, and then we look and also try to track sectors that have better growth projected than the S&P. It's not just tech. We've also got materials in there, and we've got energy in there, and energy is the one that's actually farthest out on the grid. So those are smaller in comparison, but you do have those commodity, inflation-driven sectors that are contributing, to this move a little bit as well.
Do you have a line? Do people have a line in the sand? Your clients have a line in the sand? You get to 5% on a US 10-year.
5% is a number that just seems to spook people.
And I don't know why, but
so we've looked into this in the past, and if you do a really long-term bond yield chart, and hopefully I'm not going to make my rate strategist mad, but if you just zoom out and look at a really long-term chart on 10-year yields, what you see is that if you go above 5%, my chart is no longer going to look like we're in sort of a stable interest rate environment that's kind of re-rated off the lows of post-GFC. It's going to be more of like a structurally rising rate environment. And I'll be honest, I'm just imagining this, but I think about all my analysts who cover stocks and have their Excel models, and they put in GDP assumptions and inflation assumptions, all their little macro assumptions. And I think they're going to not be too happy if we hit a 5% handle, right? Because they're going to have to dramatically change a lot of those assumptions. That's what I think is really going on.
5%. But you earlier said that 5% you'd be at 7.4, which is essentially where we are now on the S&P 500.
Yeah, if you look at the AI-related stocks, and when we look at tech specifically, we haven't done it for this AI basket exactly, but I do think this probably applies to the broader theme. You can look at the top 10 market cap names in the S&P, which is like Mag 7 plus. They really don't have balance sheets, right? If you look at net debt to cap, it's kind of like hovering around zero. So I do think there is some inherent inoculation against that interest rate move in this massive part of the market, from these interest rates moves. That's something that hits more of those kind of cyclical areas, in my opinion.
I'm going to stick to the simple math. 725 billion is the commitment at the upper end for this year in terms of the capex spent from the hyperscalers. If we get a sense that the hyperscalers are starting to slow that commitment down, how does that change your strategy, your view?
You're not going to be able to look at it at that issue just in isolation. And what I mean by that is if you look at the top 10 market cap names again in the S&P 500 and you look at their year-over-year CapEx growth rates, and we have this data for 4Q. We don't have it for 1Q yet. But we were essentially, sort of hitting peak rates of change, right? Maybe not exactly, but if you kind of zoom out on a 20, 30-year chart, you're looking pretty toppy. Well, we took that data, we looked at it for the S&P broadly, and we looked at it for the S&P X, those top 10 names. We looked at it for Russell 2000, Russell Midcap. Everything besides that top 10 market cap cohort in the S&P is in the very early stages of a CapEx recovery. So the one big beautiful bill, right, was designed to incent reshoring. I'm not an expert on the tax law, but my sense is that it didn't necessarily limit what you can spend the money on. I may be wrong on that. But what we are starting to see is those numbers creep up. So as I look at maybe, these extreme levels of CapEx spend in the top 10 market cap names, sure, I can make a case for hovering, slipping a little, slowing a little, just because the numbers are already so large. But what I'm really curious to see is if the rest of the market has a catch-up CapEx cycle. And you look at things like ISM manufacturing, now above 50 for several months in a row. ISM new orders have been perking up finally. That story has gotten completely lost with all the noise around the war, all the hype on AI and other things. I don't know if it's reshoring necessarily. It is the ISM new orders numbers are picking up. Our economists have said, there have been some tariff-related, issues baked in this. I don't know exactly what it is, but the indicators are healthy.
That's the really interesting question. How much of this stuff is coming in? Like how much are you having to import? And also how much is the AI data center build out offsetting construction elsewhere? Are the two things balancing themselves out?
Right. And so, how far does the AI impulse go through the US economy is also something I find really interesting, Laurie. And you have a focus on small caps. You like them, but not as much as the big caps. Yeah. Because I think how far the AI story gets into small caps tells us something really important about what this technology can deliver on productivity and the rest. So how far does that AI impulse go for you?
So if you think about, sort of the Russell 2000, it just doesn't have these same big chunky names that the S&P 500 has. I'm sure if I spent enough time with my small cap portfolio managers, they could tell me this story or that story benefits from AI. I don't tend to dig down into the single stock level as much anymore. But what we do know, I think it was Duke CFO survey did some work last year, and they were looking at, it wasn't small cap, large cap, but it was larger firms, smaller firms, and on some of the AI related questions, it basically showed the larger firms were right at an advantage. They were engaging more, they were doing more. I think what's interesting about the AI story right now, and this could eventually filter into small cap, is that if you put the tech companies aside, put the picks and shovels aside, look at the retailers, look at the banks, look at all, the industrial companies, all these people that could potentially use AI. They're starting to have some decent use cases. A year and a half ago, we were just reading about chatbots, and I wanted to throw my laptop out the window because it was just so annoying. I don't like chatbots. But we're starting to see, retailers or apparel companies, talk about design iteration in fashion. We're seeing, some companies talk about specific numbers around efficiencies on things like distribution centers. Some of the market data providers, who I know market data, right? But they're talking about the innovation process on their earnings calls as well. And you have to assume that some of that will filter, into small caps as well. That's still a very early story. I don't think it's really adding much to the bottom line yet, but it's really interesting to read about, and I think it's really getting overlooked by this market.
Laurie, it's nice to see you. I'm going to bring a calculator next time.
Okay.
Next time you come.
I can't.
We can put one on screen.
I'll bring my marketing deck next time, and we can just
really frightening.
A whiteboard and a
But we get to talk to you and not a chatbot that represents you. So that's
I hope it stays that way.
Don't we all? Laurie, nice to see you. Thanks for stopping by. Really appreciate it. Laurie Calvasina, RBC Capital Markets US Equity Strategy Head. Quick look at the core six. Denmark is closed today, so we've taken over Nordisk off and replaced it with Barclays. Banks are under a little bit of pressure, understandably, particularly UK banks, given what is happening in the gilt market this morning. Marc Jacobs is to be sold. Defence stocks, maybe that's a place to hide out this morning. It certainly looks like it. But ASML is the standout story to me this morning. AMAT, interesting overnight, but look at what is happening with tech this morning out of Asia into Europe, down and down hard. Let's get some more moves with Chloe Melly.
Good morning, guys. Syensqo is having a pretty good day today. This is a specialty chemicals company that serves a wide range of end markets, including agriculture and automotive. And it's having a good day because of very strong results, with profit beating estimates. And it actually said that this quarter's profit would be the lowest of the rest of the year. So that means even further growth for that company, a very bright outlook because of strong volume, strong orders. And so we're seeing Syensqo up about 5% on the back of those strong earnings this morning. Moving on to the chip sector, which, as Guy was just mentioning, is seeing a little bit of weakness this morning. We had a very strong day yesterday on the back of Trump's visit to China, but then today it is feeling some of the impact of those weakness in equity markets across Asia, feeding through to that weakness here in Europe with ASML, ASM, all of those chip names in the red this morning. Moving on to Stellantis, which is in the green. It is up this morning, slightly up about 1%, after saying that it will be making Jeeps in China with Dongfeng. So this is a strengthening of an existing relationship which has been recently rekindled. And so this strengthening of ties with China as part of Stellantis' turnaround is seen as quite positive. And so we're up a little bit this morning. And finally, Dino Supermarket, it's a supermarket chain, Dino Polska, is up very strongly this morning, about 14%. The margin beat expectations. Analysts are saying that competitive pressures have now eased, they've peaked. There's still the threat potentially of food inflation looming on the horizon. But for now, the earnings are looking very strong. The results are strong. And therefore, we are seeing that reflected in a very strong performance for that stock this morning.
Chloe, thank you. Chloe Melly with Stocks in Focus. We've got gilts in focus. So the gilt market, we are seeing yields up by 11 basis points on the 10-year. Last time I was comparing it to Italy, and it's 3 basis points more than Italy. If I'm less generous to the UK, it's around 5 basis points more than Germany.
Take a quick look at the pound, see what's happening there. What is sterling doing? Sterling had an advanced run yesterday at the Burnham story, which we didn't necessarily get from some of the other asset classes. And as you see, the British pound under a little bit of pressure. But the dollar is on the front foot this morning.
OK, coming up, a Bloomberg exclusive as OpenAI's chief revenue officer says the firm's enterprise business has, quote, incredible momentum. That is next. This is Bloomberg.
Welcome back. This is the opening trade. 20 past 8, 20 minutes into the European session. It is a feature of today's global environment that we have higher yields, and that is being factored into these markets. We see real estate on the back foot. Technology also a bit disappointed, perhaps, by what happened in China. So tech is down by 2%. Basic resources down by 3%. Tom, a little bit of nervousness around the tech space as we look at Nasdaq futures to the downside.
Yeah, and on tech, let's get a bit more detail in terms of OpenAI and its aspirations, because that company's CFO, Sarah Friar, says the company may raise more capital even after completing what she described as the largest private fundraising round ever, as the company races to secure computing power to meet surging AI demand.
The private markets have been incredibly generous to us, much bigger to tap than I think most people ever thought possible. I mean, $122 billion is literally the largest private fundraise ever. But there is something attractive about the public markets over time, too, because it's not just about equity, right? We want to be able to, over the long run, raise money across the whole spectrum. And the public markets are significantly bigger than the private markets.
I also caught up with the Chief Revenue Officer, Denise of OpenAI, who says the ChatGPT maker's enterprise business, which makes up 40% of its total revenue, now has, quote, incredible momentum.
As you use ChatGPT at home and you think about it for your personal life, then you want that same experience at work. And so today our enterprise business is 40% of our total revenue. It is growing. We expect it to be 50% by the end of the year. And there's incredible momentum.
And that 50-50 balance, you're comfortable with that? Or you want it to be lopsided more towards enterprise?
I think we want to meet both consumers and enterprises. And the focus is, especially right now, there's so much happening in the enterprise space. What we see is, I actually think we're at a tipping point in enterprise AI, because as these models advance so quickly and the innovation cycles continue to accelerate, there's this opportunity to bridge that innovation and the capability with how enterprises are thinking about adopting the capability. If you think about a couple of weeks ago, we launched GPT 5.5, which by all accounts is the most intelligent, the most intuitive, and also the most efficient model. But yet, when I'm here in Europe and actually across the globe, what I still hear from CEOs particularly is it's hard to keep up with the compounded innovation of what's happening now. And so I think the momentum, there's so much potential, really. There's kind of a vertical wall of demand in the enterprise that is left to be captured, and that's really exciting.
Does that momentum mean that you beat Anthropic on enterprise this year?
Well, what we're focused on right now is meeting the customers in where they are right now. And what I additionally hear from companies is just this transition between using AI as a productivity capability, and the real change now, Tom, is that what I hear from companies is they want to move beyond that. They want to move to bring intelligence into the complex workflows. This week, we announced a new company called the OpenAI Deployment Company. It was really designed to meet that moment, which is moving from productivity to true complex workflows requires a different operating model. So bringing a forward deployed engineer on site, working with a company so that you can understand their tools, their workflows, their systems, and then connect these models is really how you bring that true agentic capability into the enterprise. That's the real economic unlock, and we're excited about the OpenAI Deployment Company as a way to accelerate that.
What do you think investors and maybe some of your competitors miss in terms of the demand that you're seeing and your interaction with CIOs and CEOs? Is it the API use? Is it revenue per customer? Is it the contracts that you're signing around enterprise? What are investors and your competitors missing, do you think?
Well, I think what we hear from our customers, honestly, is they really love the breadth of our offering from OpenAI and the capability. For example, you can use the API, you can use ChatGPT. Codex is really having a moment right now, especially I think this is probably one thing that requires a little bit more emphasizing, but we've seen the weekly active users go from 2 million to 4 million in a matter of 30 days. And here in the UK and Germany, in fact, 9x and 10x respectively growth. 50% of that work in the UK is actually not coding, not the software development lifecycle, but knowledge work. And that is really the big opportunity, which is to transform the way the world works. And I think that's where we see so much momentum.
Does that pace of growth continue?
Yeah. Oh, I think it will accelerate. You know, the momentum around Codex right now is just accelerating through all regions. And this is the moment, actually, I think. And what I hear a lot from customers that work with us is they love, like I said, the breadth of the offering that we have, but also the way that we really lean in. We are a research and deployment company. The incredible research is on fire. The pace of acceleration can't be denied. But what we're also equally focused on is the deployment capability. And for us to bring the power of intelligence to everyone in the world and every person, we need to do both. We need to help bring the model, and we also need to help with the deployment and the adoption. And really what we hear from our customers is that is a differentiator for us in how we work with them.
OpenAI's Chief Revenue Officer, Denise Dresser, speaking to me about the demand for enterprise. It's interesting. There's a narrative out there that OpenAI has won the consumer, that Anthropic is winning on enterprise, and that Google is catching up on both fronts. And what OpenAI are really trying to make the point is enterprise is very important to them, and they are seeing that in the metrics. So 40% of the revenue now comes from enterprise. They see that going to 50% by the end of this year. They want to be serving both the consumer and the enterprise. Yeah. And interestingly, they talked a lot about agentic and that being a real pivot point in terms of the demand that comes through. There have been question marks about whether that demand was starting to slow. Yeah. They say actually that use of agentic is really starting to accelerate. And it ties back to what I think Lori Calvasina was saying, which is that the markets, Lori Calvasina was saying the market's underappreciating to what extent small caps now and smaller companies are starting to integrate and use AI and the potential upside that comes through from that.
If you want to monetize, you've got to go down that road, though, don't you? And that's the challenge at the moment. Now, Anthropic has kind of shown the way. So in some ways, they're playing catch up, aren't they?
They're trying to join that narrative, certainly, aren't they? Because that's the story. The story that the wider media has been telling has been around Anthropic in that particular part of the AI space. Coming up on the programme, we will digest what we've heard from China this week. President Trump leaves China after his highly anticipated summit with Xi Jinping. Was it a success? We will discuss with Charles Myers, Signum Global Advisors Chairman and Founder. That conversation is next. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session. Happy Friday. European stocks across the benchmark are down 0.6%. Investors having to wrestle with arguably a lack of catalysts out of the China-US meetings. Bond sell-off is there absolutely front and centre as well. And in terms of the UK, the politics, of course, and that uncertainty. The FTSE 100 currently down 58 points. The DAX over in Germany dropping 181 points. And over in France, the CAC current off by 0.6%. Guy, what are you looking at?
Let's look at the details of what is happening here. Remember that you've got the Danish market out, so the numbers don't quite tally. But volume is actually a little higher this morning, which I think is interesting as the market starts to become a little nervous about what is happening in the bond market, as Tom says. But net, we are a litlittle lower, and you can see that in terms of the figures that you've got there. Let's break it down and talk about some winners and losers and give you an idea of what is happening here. Let's talk about Polish grocers. You would have thought grocery stocks would be actually reasonably well behaved, but actually they're not. Dino Polska is up by 13%, big beat this morning. I do also wonder whether or not there's a kind of safety trade involved here, but maybe I'm stretching that a little bit too far. Anyway, that stock certainly on the move. SAP, some news out of the States overnight, maybe providing a tailwind for SAP. We're up by 1.8%, and oil stocks are higher, understandably, given what we're seeing elsewhere. But that yield story comes into play when it comes to some of the property stocks here in Europe. Unibail Rodamco Westfield, you can just about see it there, there's a lot of names, is down by 5.12% this morning. Yield plays are going to struggle as yields go higher. ASML is down this morning. You would have thought actually overnight it might be up on the AMAT story, but it's not. It's down. We're down by 3.4%. Out of Asia, you've seen a lot of technology selling. That is translating into Europe. And UK banks, unsurprisingly, given the yield move that we are seeing this morning, they are down. Barclays down by 2.2%. Anna.
Let's stick with that theme and get up to date on some of the other stories we're covering this morning. The cost of UK government debt jumps this morning as one of Keir Starmer's top rivals, Andy Burnham, prepares to run for Parliament, a process necessary for him to potentially topple the Prime Minister. The Manchester Mayor is the only senior UK politician to hold a net positive approval rating among voters, that is according to YouGov, and is the preferred candidate for many on the left of the Labour Party. LVMH is selling the Marc Jacobs brand to WHP Global. Jacobs, the label's founder, will continue as creative director for the affordable luxury label. The acquisition will push WHP Global's annual revenue to more than $9.5 billion. And the United Arab Emirates is building a new pipeline bypassing the Strait of Hormuz, with plans to have it in operation by 2027. According to the Emirates Media Office, the Abu Dhabi National Oil Company, that's ADNOC, will double its oil export capacity through the port of Fujairah once it completes the project. Guy.
Let's turn our attention to what has been happening kind of in a related story out in China, though. President Donald Trump has wrapped up his visit to Beijing. Air Force One is currently on its way home. It was interesting in terms of what was delivered there, talking about maybe buying a little bit more American agricultural products, 200 Boeing aircraft. Not a lot, actually, in terms of what was anticipated. So expectations not maybe being delivered upon. Let's bring in Brendan Murray, who leads Bloomberg's global trade coverage. Let's talk about this summit. So the Americans like to famously contain their enemies, certainly in the sort of post-45 era. But it feels like China now wants to have a little bit of that playbook as well. It wants a volatility dampener on Trump. It wants to limit the oscillations we've seen in policy coming out. And that appeared to be the message that came out of this summit from the Chinese.
Yeah, exactly. Chinese state media came out with this phrase and called the new relationship a constructive, strategic, stable one. Doesn't sound like a title that was crafted by the China hawks in the Trump administration. I think what this reflects is that the relationship has been rebalanced in much more on the terms that China would like to see them. We will see how President Trump speaks to the media in the days to come about whether he sort of falls in line with this. But if you look at if you break it down this way, the personal relationship between the two leaders, you can both sides can claim a win there. President Xi scolded Trump on Taiwan, and President Trump got the sort of made-for-television pageantry that he likes. The substance, we still don't know. We still don't have a chips deal. We didn't really get anything on AI. There was very little discussion about critical minerals. We got the agriculture and the Boeing planes, but we got something less than half of what we thought the Boeing sales were going to be, and that, to a large degree, sounds to me like China saying we'll buy 200, we'll see how it goes, and then we'll take it from there.
Okay, I was speculating at the beginning of the week, Brendan, or I was asking one of our correspondents in the region, are we going to get any more than headlines around soybeans? In the end, didn't quite get a deal on more soybeans, did we? What's the agricultural story here?
Yeah, exactly. So soybeans, if you look at the soybean market yesterday, it fell pretty sharply, and I think that was the expectation in the marketplace that those were going to come up short. The beef export deal came through, but at the moment the U.S. has a severe shortage of beef, and do we really want to be shipping beef to China when the cost of ground beef is double what it was during Trump's first term? So, there are some, there might have been a bit of an own goal there domestically for President Trump to allow that beef arrangement to go forward, but all in all, the deliverables on the agricultural side weren't surprising, and if anything, came in less than expected.
Brendan, did we get anything on rare earths versus chips, which seem to be these kind of equally balanced pressure points from both sides?
We haven't heard anything officially from either side yet. That's not to say, some of those might take longer. President Trump, as we all saw, brought a bunch of tech executives and industrialists along. So some of those still could be announced, but we didn't get anything immediately that either side could announce.
Brendan, thank you very much indeed. Bloomberg's trade czar, Brendan Murray, with the details and the context around that visit. And we get additional details, of course, from both the US and Chinese sides now that President Trump is in the air heading towards Alaska. For more analysis, Charles Mayers, chairman and founder of Signum Global Advisors, joins us now. We want to get into Iran as well with you, and maybe your take on what's happening with Venezuela when we think about the energy markets. But let's start on China and the US. Was this a win for China?
I think it was a win for both sides. First, yes, China, as the host, probably got a little bit more of an advantage because President Trump did fly all the way to Beijing. Interestingly, President Trump's tone was a lot more deferential to President Xi than the other way around. I think there was a little bit of uncomfortability back in the U.S. and in Washington that Trump was so flat, so fawning, and so again complimentary, deferential, and Xi was much more kind of serious. His demeanor was more typical and serious. However, I think that there were some positives out of this summit. First, the two sides are talking. Second, we've agreed to continue to de-escalate on trade. Third, China will commit to buy more U.S. agriculture. We'll find out how much. The big news, the new news, was China's going to buy U.S. oil. That was new. That has come out of this. That had not been agreed before. They're going to buy some more Boeing planes that you mentioned. And I would say, very importantly, and this happens in all of these bilateral summits, and the fact that we took 20 of our top CEOs over, there's a lot of commercial deals that are being done with the private sector. Last quick point, the two sides are going to keep talking. President Xi comes to Washington in September. This is all good progress.
Do we assume stability then? Through September?
Yes, absolutely. I think we'll continue to see the bilateral both steady and improving on issues around trade.
So this is a geopolitical risk that the markets can put to one side for now, US-China?
Absolutely. And I think the language around Taiwan, which would have been one of the bigger geopolitical concerns going in and coming out, was a little bit harsher, a little bit stronger and more threatening from China. But in no way did it suggest that anything is imminent or they're about to move on Taiwan. So I'd say on that big issue, it's status quo for now.
The Chinese want status quo. They want to get rid of the volatility that Trump sort of brings to the relationship. Do you think they succeeded in doing that in this trip? The language was all about trying to dampen down that volatility, trying to keep a stable relationship. You've now got this September meeting as well. Why would anything change between now and then? Is Trump being contained by China?
Well, partly. I think it's a little more nuanced than that. I would say that China, first and foremost, wants stability. They want stability around the world. They want stability in the relationship with the United States and directionally more positive developments on trade and other areas. And they also would like to see the war in Iran end, not anytime soon because they're the biggest winners. But ultimately, China is projecting, even through this bilateral meeting in Beijing, China's projecting to the world that they are the more stable and more reliable superpower, while the United States is at war in the Middle East and while we're still at war in Ukraine. So I think China's come out ahead of the summit looking much better and more stable. But the truth is the two sides and the overall bilateral is in a much better place than it's been in 20 years. The goal is to keep that going on trade, commercial deals, and geopolitically.
Why is China the biggest winner from the war in Iran?
They're the biggest winner because they can buy very heavily discounted Iranian oil. They buy 90% of Iran's oil. They can get it at a very big discount.
How do they get it?
There's other ways. It doesn't all come through the Strait of Hormuz. Secondly, the Chinese look like, again, a much more stable partner and a superpower. And thirdly, the United States is burning down or using up a lot more military hardware than we expected to fight this war in the Middle East, even taking some of that hardware out of the Indo-Pacific and moving it to the Gulf so that we can do what we think is going to happen, which is re-escalate in Iran. So on every level, China's the winner. And I think they ultimately would like the war to end at some point, but they're in no hurry. If they'd wanted the war to end, they could put enough pressure on Iran literally to get to the table and agree to reopen the strait today.
Charles, so you think that we will see a re-escalation now? So we for a while been thinking about this meeting coming up and thinking, well, maybe nothing very kinetic will happen in the run-up to it. But now the meeting is behind us. You do think then that we will have a return to military action? Will it be of a similar scale and scope as previously, or something much more contained?
So, so just the first part, the answer is our base case is the United States will have to re-escalate militarily. Secondly, no, it will not be small and contained. It is going to be a major military operation, which most people are underestimating. It'll be a combination of, and on timing, if I can, just quickly to say, if we can't get to a deal with Iran in the next 3 or 4 days, 5 days, President Trump will realize what he already knows, that Iran is just stalling in the negotiations. The only way to get to a deal is Iran has to agree to reopen the strait unconditionally. The nuclear stuff we're punting into the future. If that doesn't happen, I always say, if you think that Iran's going to reopen the strait unconditionally, we have a deal. That's very good news. We don't believe that. So the military option is going to be a much bigger campaign on two fronts. The United States and Israel take the Strait of Hormuz militarily through a combination of air, naval, and personnel. At the same time, shock and awe across Tehran on military, government, and civilian infrastructure, as well as another wave of assassinations of the leadership, including the new Ayatollah. So the objective in this, if we go back in the next 2 to 3 weeks, which is our base case, is to decapitate the regime and find a group of generals that are willing to come to the table, be pragmatic, and reopen the strait.
Okay, so, I mean, it seems as if, because last time we spoke was in March, things were still very live, and at the time there was a widely held view that this would not last very long because an off-ramp would be sought, and I think you shared that view, Charles, but things didn't quite play out that way, or it took a little bit longer for the kinetic activity to die down. Do you think there's a misunderstanding in Washington of the enemy here? Do you think people understand who they're up against and the motivations of that enemy as well?
Oh, absolutely. Look, in war, the biggest mistake you can make is to underestimate your opponent. And in this case, the United States, and Trump says this openly, really believed that Iran would capitulate in the first week. That obviously hasn't happened. And now we're 12 weeks into a war that I would argue the opponent, Iran, is even more powerful because they have a chokehold on the global oil market and therefore a chokehold on potentially on the global economy. This war has gone not to plan at all. It is off the rails. Trump needs a deal. Keep an eye on the 10-year yield. The 10-year yield's at 4.5. If it goes to 5, Trump will capitulate. He'll take any off-ramp, any language around reopening, even with a toll in the Strait of Hormuz. If price of oil goes to 120 and stays there for a week, he'll also capitulate.
Yeah. But I mean, last time you thought that 4.5 was key and that oil over 100 was key. Do you think is Washington having to reevaluate these sort of red lines?
Yes, absolutely. Because again, the war has gone so badly, and we're so far in that we actually have new. Trump keeps moving the goalposts on everything from what the forcing mechanisms for him to get to a deal are, but also he keeps moving the goalposts on what an actual agreement looks like. At first it was no nukes at all. Now it's like, all right, we'll punt the nuclear discussion into the future. Now it's only about reopening the strait, and we'll maybe give you some language around toll, but we're not sure. So the war's gone really badly. Trump needs a deal. Our midterms are coming up. Price of gasoline's at $4.55. And so one good thing on this, not that there are many good things in war, but we will not be having this conversation a month from now. We will either have in the next 2 to 3 weeks a deal, the diplomatic off-ramp remains, or we're going in such size and we'll decapitate the regime, and it's going to be huge, but it will be short. So we're kind of in a crossroads. I'd say the next 2 to 3 days are the most important in terms of direction of this war, off-ramp or kinetic.
I thought I was going to have a quiet weekend.
Yes. Well, we're all going to be busy this weekend.
Again, Charles Myers, thank you very much indeed. Another busy weekend. How do we? Are we okay with this? Another busy weekend?
You look stressed, Guy.
Well, no, it's just kind
Well,
of...
I think it's worse if you're in the region.
Yes, probably. No, that probably is true. Charles Myers, thank you very much indeed. Nice to see you. Coming up, pressure on gilts, the pound and the Prime Minister as speculation swirls around who will step up as challengers for the UK's top job. More on that next. This is Bloomberg.
Welcome back to the opening trade. Happy Friday. We are 49 minutes into today's session. European markets are down across benchmark, down 0.8%. Here in the UK, the FTSE 100 has fallen 83 points, down 0.8% as well. Some heavier losses over in Germany. The DAX off by a full 1%. Yes, it is risk off in this session, and the bond market sell-off is certainly a factor for investors, Anna.
Yeah, let's have a look at where we are on the bond market story, because this is not just a UK story, but the UK is certainly looking pretty punchy. In terms of the, where are we there? There's the 2-year yield, the 10-year yield, 30-year yield. You can see they're all heading higher, between 9 and 11 basis points across the curve. This comes amid the prospect of that the Prime Minister will have to fend off rivals for the UK's top job. For more, let's bring in our UK correspondent, Lizzie Burnham, who is in Downing Street. So, Lizzie, talk us through where we are now. Where do things stand for Keir Starmer?
Well, no formal challenges yet, Anna, but the bond market can see where this is headed. The Greater Manchester Mayor, Andy Burnham, has already taken his first step towards toppling the Prime Minister. The MP for Makerfield, Josh Simons, announcing yesterday that he's going to stand down in order that Burnham has a chance at standing for his seat, a path back to Parliament. We've also had the Health Secretary, Wes Streeting, resigning from Cabinet. He has called on Starmer to facilitate a contest, and Starmer's former number 2, Angela Rayner, has said that she's been cleared of a tax probe and refused to rule out challenging the leader. Now, of all of them, Burnham is the man that Polymarket sees as having the highest chances replacing Starmer, but there are lots of hurdles in his way, Anna. First of all, he'd have to be approved by the National Executive Committee, even if Starmer doesn't stand in his way. Then he'd have to beat Reform at a by-election, and you can bet Reform will throw the kitchen sink at this, given Makerfield was the seat when they got their 6th highest vote share in 2024. On top of that, if Starmer can win the by-election and say, yes, I'm the man to fight Farage at the general, he'd have to get 81 Labour MPs to back him in the leadership contest. That'll be testing the patience of Labour MPs. And all of this will be testing the patience of the gilt market, the uncertainty that is about to unravel over the next few months.
Yeah, and that's the issue, isn't it, here, Lizzie? This is the next few months. Is UK policy effectively on pause here as we wait for Burnham to fight a by-election, and then we figure out how a Labour Party leadership challenge process unfolds? How long are we in stasis for until we get some clarity on what is going to happen next?
Well, yeah, you hear it from officials in there, just the frustration that they're struggling to get on with government, with the distraction of this leadership contest brewing in the background. And for markets, it is a nightmare. Already you've seen gilts up sharply, yields up sharply at the open. Do need to put it into context of yesterday's drop in yields. The pound, as Anna says, down against both the dollar and the euro. It was already at a month low on cable. And all of this uncertainty only to hang over it, because the fearing markets is that you get somebody less fiscally prudent in there than Keir Starmer. That seems to be what you would get from Burnham, given his previous comments about not being in hock to the bond market. He's walked them back somewhat, but the market seemingly finding it difficult to forget.
Lizzie Burnham, thank Thank you very much indeed in Downing Street for us, of course. Let's bring in a markets perspective now as well with Bloomberg M Life strategist Adam Linton. Adam, we're seeing yields up and bonds selling off again. To Lizzie's point, gilt's in focus, of course, with energy, but also that political risk. How far does this go? Is this priced in now? Do we get to 6% at the back end of the gilt curve? What are you thinking about in terms of potential additional pressure on the gilt market, or whether or not things will settle down a bit?
Yeah, I mean, definitely yesterday when we spoke, there was an element of, why is cable still above 135? The moves in yields didn't look particularly disorderly. And I think at the time, that was there was a lot of uncertainty. We didn't know, is there going to be a leadership race? Who's going to be in it? What's their policy platform? And incrementally, we've got a little bit of further detail on that. We've now seen that Burnham has entered the fray. But, as Lizzie mentioned, there are a lot of hurdles to him be able to actually take position. And, we don't necessarily know exactly what his policy platform will be. So, yes, we've seen some increases in yields today. We've seen the pound down, but there's also bigger context. It's been an up week for global bond yields. We've seen hot inflation reports in the US and Japan. I mean, a relatively strong dollar environment. So if you look at the moves, I'd say they're not actually that disorderly at the moment. And I think there is an element of we still don't quite know exactly how this is going to play out. I mean, in conversations I've had on the desk is Andy Burnham actually going to be that left-leaning? I mean, he served the Gordon Brown. Yes, there's a comment about being hot to the bond market, but he's walked that back. So things may not actually be as bad as we were fearing at some stage. I mean, obviously, yes, things could potentially be rocky. He's going to have to win over the Labour grassroots, or any candidate is going to have to do that. So he may sound a bit more left-leaning. But for now, I'll say, if you look at the moves compared to other European benchmarks, they're not actually that extreme. So it could be more of a slow burn for UK assets.
Yes, so, and not as bad in the sense of yields going higher and borrowing costs going higher for the UK government. Bloomberg Economics diving into some of the things he said in the past about what his policy platform would be, cutting the basic rate of income tax but putting it up at the top end and introducing some kind of wealth tax, also exempting defence spending from fiscal rules. I mean, we don't know. Who knows? We'll have to wait and see what he says. But it does that defence reference also takes me up. This is a world of rising yields, isn't it, at the moment? Because there are lots of governments around the world wrestling with how on earth you spend on these things, and you need to find the money from somewhere. How does this sit with the rising yield environment that we're seeing globally? Because there are other non-UK drivers.
Yeah, no, they're definitely, I mean, the big question at the moment is, isn't just a UK politics story. There's so much more going on in bond markets, and we've seen that on display this week. And I think ultimately the real, release valve, if there is to be one for the market, is the Strait of Hormuz. And obviously, Trump's comments overnight, they're particularly concerning because the narrative we've been spinning is that markets, equity markets, they can keep going as long as there's progress towards a resolution, as long as there's no more kinetic action in the Middle East. That's obviously kind of been challenged, and you'll be kind of seeing that play out in the yield space. I mean, you've got 2 yields above 4, 10s above 4.5, and 30s above 5. I mean, is there a particular pain point for the US at which point, Trump does make some pivot, but ultimately, will any pivot be successful? There's so much uncertainty about how this is going to play out. Making those sort of fiscal, commitments, as you were saying, is incredibly difficult in this environment, which again could actually potentially be good news for those concerned about how left-leaning a potential future Labour government could be, as ultimately the hands could ultimately be tied anyways.
Nice to see you. Thanks for stopping by. Have a great weekend. Looking forward to the weekend. Adam Linton from our Bloomberg M Live team. Busy weekend coming up. There's a Cannes Film Festival. There's a Eurovision final, which I know Tom's watching.
Did you know Guy bought a karaoke set especially for this?
I'm dressing up.
I think he's booked his trip to Austria, and that's where he's dressing up, aren't you?
Guy Johnson and Lederhosen.
He'll be there in Vienna, waving the flag.
Yeah, looking forward to it. I'm maybe going to watch the golf.
Shall I give you some Hearts Celtic stats?
Yeah, this is amazing.
This is amazing. Okay, yeah. This is tomorrow. Hearts have won the Scottish League 4 times. The last time, 1959, 1960.
Yep.
Celtic have won it 55 times.
Yes.
And this is the final tomorrow.
It's like Leicester winning, isn't it?
Yeah. It's going to be epic.
That one for our editor-in-chief.
Got to back Hearts.
Yes. It was a long time ago.
Yeah, that is it for the opening trade. The Pulse is coming up next. It's Friday, everybody. This is Bloomberg.